Hello, everyone. Welcome back to Financial News. I'm Ron Jankowski with Channel 4, and of course, Paul Munichel is with me as a co-host from Ameriprise Financial. Today's date is August 22nd, 2022. Paul, we're moving along to the latter part of the year. We're going to be going into the fourth quarter. Lots of things are happening since the beginning of the year. You have things, I'm sure, to share with the viewers from at least last week, and I will repeat some of the information we got from Ameriprise is effective this morning.
Great, thanks. Today, for the first half of the show, I'm going to focus on some of the new legislation that was passed and how it may affect you. So the two new important pieces of legislation that were passed into law over the past 2 weeks. Now, the first advocates billions in federal incentives to manufacture critical semiconductors here domestically, thus narrowing a major strategic vulnerability. The second piece of legislation is much larger and focuses on climate, remediation, healthcare costs, and some new corporate taxes. So let's look at each one individually. The first one being the CHIPS and Science Act. Now, this legislation primarily offers $52 billion in government funds to enhance U.S. research, development, and manufacturing of semiconductors. The legislation's purpose is to strategically strengthen U.S. access to semiconductors over the long term. Now, the second piece of legislation is the Inflation Reduction Act. This legislation increases spending on climate remediation efforts, targets healthcare costs, particularly in Medicare, and boosts some corporate taxes. Of particular interest to investors, the IRA sets a corporate minimum tax on book profits of 15% and institutes a 1% excise tax on share repurchases. The 15% minimum tax may disproportionately impact some of the market's largest companies. However, the provision is forecast to raise what we believe is a manageable 20 to 30 billion a year in added taxes, and that's relative to total S&P 500 earnings before interest and taxes. That's all according to the Joint Committee on Taxation. Meanwhile, the 1% net tax on share repurchases is expected to generate tax revenue of 6 to 8 billion, and again, according to the JCT. This is just general recap of these two legislation bills. There's certainly much more detail on them both, but in a nutshell, that's what's happening in these.
Well, I also got some information just received from Ameriprise, and I'll read that to you. U.S. stock index futures are lower, down over 1% this morning after ending a 4-week win streak on Friday.
Yeah, it looks like Monday's opening might be a rough one. The opening isn't the close, obviously, but it looks like we're set to open in a downward direction.
Now, they're saying that investors will be focused on Powell's speech scheduled for Friday at Jackson Hole. Who is Powell?
The Fed Committee.
Fed Committee. Yeah. So, Fed Committee will be having a speech.
Jerome Powell, yep.
Okay, markets in Asia, they're saying are closed mostly lower, while Europe is trading weak and led by German DAX minus 2% at midday.
So those markets are down, and thus that's carrying over into our futures in a downward direction.
Treasury yields are lower with some curve flattening as the 10-year bumps up against 3%, with the 2-year at a 3.27%.
Nothing drastic there.
No. Bitcoin down another 1% pre-market. WTI crude flat, but coming off a 2% pullback last week, and gold is 1%. Now, the crude coming off of a 2% pullback could mean there could be a slight increase again, but we don't know which way is that.
No, pullback would mean it's down, right? So
it's down, yeah. It's a 2% pullback last week. but it's coming off of that. So
Right.
what does that mean? We don't know.
We'll see.
Yeah, exactly. Now, the year-to-date S&P 500 is a minus 10%. The Dow Jones year-to-date a minus 6%, and NASDAQ year-to-date a minus 18%.
The
You
year's not
expect
over.
that?
Yeah.
Yes, exactly.
We're hoping that we can make these percentages back before the end of the year. There's people out there that believe that's possible. There's people out there that believe it's not possible. So time will tell, and we can just hope for the best.
Thank you, Paul, for the update. Stay with us. We'll be right back. We're going to have our show called Your Money, and Paul has an interesting topic, and stay with us. And we're back with Your Money, and Paul has an interesting, as usual. Are you worried about the stock market, and should you dive first, and what you should take into consideration? And number one, you better get some help, and that better be a financial advisor, someone that knows and understands what's going on.
Yeah, and I picked this topic, today primarily due to the futures move downward that you had mentioned in the first half of the show, Ron. So yeah, worried about the stock market. Today we're going to talk about how to maybe reduce some of your investment risk during times of market volatility like we're in now and like we've seen since the start of 2022. So to begin, it's natural to feel a bit skittish about the stock market given the start we've had for 2022. It's a potent reminder that there are risks to stock ownership. Individual stocks are not guaranteed to grow and may lose value. The good news, though, is that the stock market has historically delivered a higher rate of return than other forms of investment in the same time frame. Now, with this in mind, there are strategies you can deploy to help insulate your portfolio from the natural up and down swings of the market while staying invested for the long term. One strategy is buy and hold. Now, there will always be day-to-day fluctuations in the stock market. Plunging stocks can cause panic selling. Rising stocks can inspire overly optimistic purchasing. A buy and hold investment strategy takes a long-term view to investing. It discourages buying or selling stocks in response to market dips and surges. Over time, portfolios governed by this strategy, they tend to deliver more robust long-term results than ones guided by emotional decisions. Second strategy, and to anyone watching this show, it's not new, asset allocation. This strategy involves holding investments across several different classes to meet your investment objectives. Asset classes, some of them include stocks, bonds, and cash, and alternatives. Each asset class has a different risk profile and upside potential. Now, how much you assign to each asset class will depend on your individual circumstances, such as your time horizon, tolerance for risk, need for liquidity, tax situation, and your financial goals. Investors with a longer time horizon usually can tolerate more risk, so will hold a larger percentage of stocks within their portfolio, while investors with a shorter time horizon may consider holding more bonds or similar instruments that may offer greater security with lower yields. Another strategy, again, not new to our reoccurring viewers, is portfolio diversification. Portfolio diversification is another strategy designed to help you spread risk across your portfolio. It involves selecting a variety of investments within each asset class to help minimize risk. So for example, by putting your growth stock money into several companies that meet growth criteria, you are protected in the event that just one of those companies fails. A strategy to consider is dollar cost averaging. This type of investment strategy takes a disciplined approach to purchasing investments. The idea is to purchase more shares of stocks, bonds, and mutual funds when prices are low, and purchase fewer shares when the prices are high. The principle here is to be systematic in your purchasing. Dollar cost averaging over time usually can result in lower average cost of shares in your portfolio, creating greater opportunity for profit as share values rise. In conclusion, find an ally for your investing. Talk with your financial advisor to learn how to implement these and other investment strategies to help grow your investment portfolio. And as with all investments, remember, past performance does not guarantee future results, and no investment strategy is guaranteed to be profitable or help you avoid losses. Common sense and a balanced approach tend to win at the end of the day.
Boy, is that interesting to hear all these different options that you have to take into consideration. And the most important thing is what your projections are for your portfolio. What are you really looking for? And you really need to have someone, especially when the market is so, it's up and it's down, it's trying to make corrections, and some stocks are doing very well. So you really need to evaluate what is the best option for you. Maybe a few of them that you had mentioned it needs to be incorporated into your portfolio.
And your money and your investments, it's emotional. Ups and downs with the market, they create stress in people's lives and turmoil. And that's why, of course, I'm going to recommend talking with a financial advisor just so you can get guidance over the big picture of the market and what it's done in the past and how it may do in the future. Of course, no guarantees, but if you're sick, you speak to your doctor. If you buy a new car, you speak to your insurance agent. Your investments, you should speak with a professional. When it comes to taxes, you may be able to do it on your own, but a lot of people talk to a tax advisor. So this should be no different. And if you're looking for a financial advisor, feel free to give me a call directly, and I'm at 708-226-3412.
Thank you, Paul, for bringing this to the viewers' attention. For Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 in Palos Heights, we wish you good investment day.